Today we're going to dive into one of the most fascinating and often misunderstood topics in investing. What is a stock split? It's more than just a math trick. It's a psychological play, a strategic move, and sometimes even a clever marketing tactic. We'll explain how companies split their stocks, why it doesn't change their overall value, and how to avoid the trap of thinking something is more affordable than it really is. Stick around until the end so you don't lose money chasing flashy trends like splits. And don't forget to like and subscribe to support the channel. Imagine this. You open your brokerage app and suddenly notice that instead of holding 100 shares of a company, you now have 200, or even 700, and you didn't buy anything extra. This isn't an error or a gift from the universe. This is a split. A stock split is when a company increases the number of shares outstanding by decreasing the price of each one proportionally. So if you owned one share worth $1,000, after a 2-for-1 split, you'd have 2 shares worth $500 each. You didn't get richer or poorer. The pie is the same, just cut into more slices. That's the key idea. More slices don't mean more pie. So why go through the trouble of slicing things up? It all comes down to trading convenience. Historically, in the United States, when a stock approached the $100 mark, companies started to get uneasy. Why? Because the standard trading lot is 100 shares. That means to buy the smallest possible unit, you'd need to pay $10,000. And if you're a retail investor with limited funds, you're out of the game. A stock split brought prices down and made the shares feel more approachable, attracting more investors. This was especially relevant before fractional shares were a thing. Nowadays, brokers let you buy 1/10 of a share, but back then it was all or nothing. Splits made stocks look more affordable, not in terms of actual value, but in perception. But let's not rush. Splits often serve deeper corporate goals. Join our Telegram channel for updates on new videos and articles. You'll find the link in the description or the first pinned comment. So why do companies even bother with splits if no one's gaining or losing money? It's all about perception. A company wants to signal that its shares have grown so much, they've become out of reach for the average investor. Now it's making a generous move by splitting them and lowering the price. That increases liquidity, makes the stock more appealing, and can even boost the price short term. Even though, as we've just seen, nothing has fundamentally changed. Sometimes it's pure marketing. We live in a time where perception often trumps reality. Investors see a split and think, this company must be doing great. That creates a wave of psychological demand. Let's look at this from your perspective as an investor. You had 10 shares priced at $100 each. After a 2-for-1 split, you now have 20 shares at $50 each. Nothing's changed, except now it's easier to manage your portfolio. Want to sell 1/3 of your position? Now it's 7 shares, not 3 and some awkward decimals. A small thing, but convenient. And for the market, that's added liquidity. Still, it only works one way. No matter how much you slice a pie, it doesn't grow. And in the case of stocks, market capitalization stays the same. Market cap equals the number of shares times the share price. Cut in half, price drops in half, share count doubles. The result? No difference. Say a company's stock is trading for pennies. It's stuck at the bottom of the rankings, and investors barely glance at it. That's not just a reputation issue. Some exchanges won't even list stocks that fall below a certain price. For example, if a stock drops below $1, it might get delisted. To avoid this, the company may do a reverse split. That's when they combine shares to raise the price. So, if you had 20 shares at $1 each, after a 1-for-20 reverse split, you'd have 1 share worth $20. Same pie, fewer, but bigger slices. It's not a rescue plan, more like a facelift. In fact, companies often do reverse splits when they're in trouble. It's common during financial downturns. Can a split be a good sign for investors? Sometimes, yes. Companies usually split their shares when prices are going up. That could mean things are going well, business is booming, and the market cap is rising. But don't get fooled. A price increase alone doesn't mean success. It all depends on why the split happened in the first place. Here's a deeper question. Why do share prices often rise after a split if the company's value hasn't changed? The answer lies in market psychology. Investors see a split as a sign of strength and growth, and a cheap stock suddenly looks like a great deal, even though it's only cheap on the surface. That illusion of affordability is one of the biggest traps for retail investors. But how does this all play out today, in a world of digital platforms, user-friendly brokers, and fractional shares? In today's market, stock splits don't hold the same practical weight they once did. You can invest in any company with as little as $10. Platforms like Robinhood, M1 Finance, Revolut, and many others let you buy a tenth, a hundredth, even a thousandth of a share. Want to invest in Tesla but don't have $2,200? You buy 1/10 for $220 and you're in. So why even bother with splits anymore if they're not technically necessary? Again, it's about perception. Most people still react to numbers. A $1,000 stock feels expensive. That same stock at $100 feels affordable. It's a mental shortcut, and PR teams know exactly how to use it. They create the illusion of opportunity without changing anything real. Investor psychology is a powerful force in the markets. People assume a cheaper-looking stock must be more accessible and ready to grow. That creates extra demand, and yes, sometimes it even pushes the price up. A self-fulfilling prophecy, but it doesn't last forever. Once the market realizes the split was just optics, that demand fades. Interestingly, in recent years, we've seen more splits in response to rising retail investor interest. Apple, Tesla, Amazon, they all announce splits during times of huge public buzz. It's a way to grab attention, boost brand appeal, and maybe get a short-term price bump. Sounds tempting, but a smart investor always asks, has the real value of the company changed? Back to the pie analogy. You always get the same amount of filling, whether it's one big slice or 4 smaller ones. But if you think 4 slices look better, the pie maker will gladly use that to their advantage. The stock market works the same way. There's a new article up on our website. We've got free content on stocks, bonds, and ETFs for every level, from beginner to advanced. Check it out and bookmark the page. In today's market world, where buying full lots isn't required and fractional shares exist, splits are mostly psychological. They're more of a media tool than a financial necessity. They drive attention, headlines, social media posts, hype. And it all benefits the company by raising awareness about their stock. But a seasoned investor doesn't fall for the surface. They dig into the fundamentals. Understanding how splits work can save you from common mistakes, like falling for cheap stocks right after a split, or panicking during a reverse split that's more technical than catastrophic. It's also crucial to know the difference between price and value. Price is what you pay. Value is what you get. A split changes the price, not the business. That's why careful analysis of financials, growth potential, and company strength always beats the latest headlines. A stock split is just a tool. It might make your investing life easier, it might give a company more buzz, or it might not matter at all in your portfolio. The key is, don't act on impulse. Don't be fooled by the numbers. Real wealth isn't in the number of shares you hold, it's in their quality. Like this video and subscribe to the channel. Support our content on our membership platform. The link is in the description or the pinned comment.